October 15th, 2024. The S&P 500 closed down just 1.8%. Financial headlines called it a routine pullback amidst geopolitical noise. But in the shadows of closing auctions and dark pools, a critical, invisible line was breached, triggering the first automated sell orders from managers controlling over $2 trillion. The index had sliced decisively below its 200-day moving average, a key technical level monitored not by TV pundits but by the cold logic of systematic trend-following strategies. More critically, the CBOE volatility index term structure inverted. The price of near-term VIX futures jumped above longer-dated contracts for the first time since March 2020. This wasn't just a bad day. It was a regime shift in the volatility market, a flashing red signal that professional fear was outpacing public awareness. To the public, it was a minor setback. To quant funds, risk-parity funds, and volatility-targeting algorithms, it was a Phase 1 alert. Their models, programmed with strict risk parameters, began automatically de-risking. According to documented allocations from firms like AQR and Bridgewater, a typical risk-parity fund would now be forced to sell approximately $12 in equity exposure for every $100 under management to maintain its target volatility. This selling is silent, emotionless, and inexorable. It doesn't wait for news. It reacts to price and volatility signals alone. How does a 2% drop metastasize into a 20% crash? The answer lies not in human panic, but in the predetermined cascading logic of trillion-dollar machines. The fuse was lit not by a bankruptcy or a central bank, but by a mathematical condition. The first domino to fall wasn't a bank, it was a moving average. And as Thursday, October 17th, dawned, that domino began tipping into the next. The market of October 2024 wasn't weak from bad news. It was a masterpiece of structural fragility, operating on the suicidal assumption of perpetual, smooth liquidity. On the surface, strength was the only narrative. But beneath that polished veneer, economist Hyman Minsky's infamous framework was completing its final, fatal stage, the Ponzi finance phase, where stability itself breeds instability. The system was saturated with hidden leverage. According to data modeled on Federal Reserve financial accounts, non-financial corporate debt to GDP hovered near historic peaks, while speculative margin debt, the kind used not for investment but for betting on bets, remained dangerously elevated. More insidiously, the options market had transformed equity volatility into a ticking bomb. The collective gamma exposure of major dealers, stemming from an explosion in 0 days to expiration, or 0DTE options trading, had created a reflexive feedback loop. Any significant drop would force these dealers to dynamically hedge by mechanically selling stocks, accelerating the very decline they were insuring against. Simultaneously, the market's foundation had narrowed to a dangerous point. The top 10 S&P 500 constituents, the so-called magnificent cohort, had swollen to represent over 35% of the entire index's weight, a concentration level unseen since the Nifty 50 era of the early 1970s. This wasn't just a bet on a few companies. It was a bet that none of them would ever meaningfully stumble. The entire index was now held hostage by the earnings report of a single tech giant. Finally, the most dangerous illusion was liquidity. Daily trading volumes, pumped by passive ETF flows, painted a picture of deep, resilient markets. But true liquidity, the ability of a pension fund to sell a $500 million block of stock without crashing its price, had been evaporating for years. Bank for International Settlements research had long warned that high-frequency traders and market makers had withdrawn genuine capital commitment, creating a liquidity mirage. The market could handle the small, retail-sized orders of a calm day, but it had lost the structural depth to absorb a genuine wave of institutional fear. The forest was a tinderbox of dry kindling. Excessive leverage, extreme concentration, and phantom liquidity. All it needed was a spark. On October 21st, that spark arrived. The fuse met the tinder on Monday, October 21st. The sell-off ceased being technical and became fundamental, driven by a triple shock that hit every major asset class simultaneously. First, a sudden, dramatic escalation in an ongoing geopolitical conflict sent Brent crude prices spiking 15% in 48 hours, reigniting stagflation fears. Then, on October 22nd, the Bureau of Labor Statistics delivered the knockout punch, a scorching hot CPI print that forced the market to violently reprice the Federal Reserve S-path. The narrative of peak inflation and imminent rate cuts shattered instantly. Traders now priced in 2 additional hikes. The final shock was a credit event, a massive, highly levered private equity deal. Its debt trading in the opaque secondary market faced a cascading margin call it could not meet. This triggered a fire sale of investment-grade corporate bonds, an asset class traditionally seen as a safe haven. The result was a correlation breakage of catastrophic proportions. For the first time since the 2008 crisis, stocks and U.S. Treasuries fell in unison. The 60/40 portfolio, the bedrock of modern institutional investing, imploded as its hedging mechanism failed completely. Academic research, including pivotal BIS studies, identifies this simultaneous decline as the definitive hallmark of a systemic liquidity crisis, not a mere correction. The only asset that soared was the US dollar, as a global dash for cash commenced. A stronger dollar, however, acted not as a safe haven but as a financial vacuum, sucking liquidity out of global markets and tightening the noose on foreign corporations with dollar-denominated debt. Diversification had become a myth. Every exit was clogged. With the classic investor playbook in ashes, the market's internal plumbing, the repurchase agreement repo markets, the prime brokerage channels, the settlement systems began to seize. The computers were no longer just selling. They were scrambling for dollars that were rapidly disappearing. By Monday, October 28th, the crash ceased to be about earnings or economics. It became a failure of the market's circulatory system. The financial system began suffering a liquidity heart attack, starting in its core, the repurchase agreement or repo market. Here, banks and funds borrow cash overnight, using treasuries as collateral. It is the grease for the global financial engine. That grease evaporated. The secured overnight financing rate, SOFR, the heartbeat of this market, spiked 150 basis points in 48 hours. This wasn't a gentle rise. It was a fibrillation, signaling acute dollar funding stress as institutions hoarded cash and refused to lend even against pristine collateral. Simultaneously, the world's deepest market, that for U.S. Treasury securities, seized. The bid-ask spread on the 10-year Treasury future, typically a fraction of a basis point, ballooned to levels unseen since the COVID panic of March 2020. When the market for the planet's ultimate safe asset loses liquidity, every other asset is doomed. This dysfunction was amplified by crippled intermediaries. Primary dealers, the institutions obligated to make markets and treasuries, had entered the crisis with constrained balance sheets. As volatility exploded, their risk models screamed at them to pull back. Their capacity to warehouse bonds and provide liquidity evaporated, turning orderly selling into catastrophic gap downs. Then, the volatility bomb detonated. The VIX, the market's fear gauge, closed above 50. This number triggered two catastrophic mechanisms. First, it forced mandatory, automated hedging by the sellers of billions in volatility-linked products, creating a feedback loop of buying VIX futures and selling S&P futures that accelerated the collapse. Second, and more insidiously, a VIX above 50 triggered massive increases in capital charges for banks and funds under internal value at risk VAR models. To reduce these charges and meet margin calls, they had to sell their most liquid assets, stocks and bonds, further draining the system of the very liquidity it needed to survive. The market was no longer pricing companies. It was pricing its own breakdown. The machinery of trading itself was collapsing under recursive, self-fulfilling stress. This was the pivotal shift from a market crash to a systemic event. And this is when the real carnage began. The week where investment strategies specifically engineered for safety transformed into undiscerning engines of destruction. The week of November 4th unveiled the true horror of modern finance, a self-reinforcing vortex of mechanical, emotionless selling. This wasn't investors losing faith. It was algorithms executing predetermined rules, transforming passive vehicles into vectors of contagion. The cascade began with risk-parity and volatility-targeting funds. These systematic strategies, designed to balance risk across assets, were hit by the unprecedented dual collapse of both stocks and bonds. Their models, blind to cause, responded to the soaring volatility signal with one command: delever. En masse, they initiated simultaneous sell orders across all asset classes, dumping billions in equities, treasuries, and commodities into a market with no buyers. Next, the ETF machinery broke. Authorized participants, APs, the arbitrageurs who keep ETF prices aligned with their underlying holdings, faced an impossible task. Massive redemption orders poured in, but the underlying assets, especially corporate bonds and small-cap stocks, were untradeable. The arbitrage mechanism seized. ETFs began trading at steep discounts to their net asset value, a flashing siren that the wrapper was broken, panicking investors into selling the ETFs themselves, which pressured the underlying holdings further, a vicious, paralyzing loop. Meanwhile, prime brokers issued a tsunami of margin calls. Leveraged hedge funds, speculative family offices, and retail traders piled into zero DTE options faced with demands for cash they couldn't raise, triggering forced liquidations of any remaining positions. The final, cruel twist came from pension funds. Their end-of-quarter rebalancing protocols, designed for stability, now demanded they sell stocks to buy bonds, mechanically dumping equity into a market already in freefall. Analysis modeled on prime broker data suggests over 60% of sell volume this week was systematic and involuntary, a run dynamic driven by code, not conviction. As the major indices plummeted another 10% in 5 days, the carnage seemed complete. But the true black swan, lurking in the complex derivatives market, had yet to strike. The systemic crisis was about to enter a new, uncharted phase. The climax arrived not from a bank run, but from a derivatives explosion. As the VIX index surged towards an unthinkable 80 in the week of November 12th, the hidden neutron bomb of the 2020s bull market detonated. A massive, diffuse pile of short volatility bets embedded in structured notes and levered ETFs sold to retail and institutional investors alike. These products, which promised enhanced yield by betting against market fear, now faced terminal margin calls and automatic liquidation. The issuers, major global banks, were contractually obligated to make their investors whole. To hedge this catastrophic liability, they were forced to buy VIX futures in a violently spiking market. This created a parabolic feedback loop. Rising volatility forced more hedging buys, which pushed futures higher, triggering more liquidations, a classic short squeeze on market fear itself. The system reached its breaking point. Rumors swirled that a European megabank, hemorrhaging from these derivatives exposures and facing frozen funding markets, was on the brink. The insurance against its failure, credit default swap spreads, exploded, signaling a potential Lehman-like counterparty crisis. The interbank lending market froze. The liquidity heart attack was triggering cardiac arrest. Faced with a modern Volmageddon, magnified by an order of magnitude, global authorities executed a coordinated nuclear option. In a historic move before the open on November 13th, the Federal Reserve, U.S. Treasury, and European Central Bank issued a joint statement with 3 unprecedented pillars. First, they activated and dramatically expanded a standing repurchase agreement facility offering unlimited liquidity against a wider range of collateral, including now-stressed corporate bonds. Second, financial regulators announced an immediate temporary ban on the short selling of global financial stocks to halt the predatory run on bank shares. Third, and most critically, the Fed signaled a surprise intermeeting emergency rate cut, explicitly framing it not as stimulus, but as a bridge of liquidity to prevent systemic seizure. The market's reaction was a historic, violent short covering rally of over 8% in a single session. This was not a recovery born of optimism. It was a mechanical, panic-driven reversal of leveraged bets, supercharged by the sudden removal of existential systemic risk. It was a lifeline, not a cure. The intervention succeeded in preventing an immediate, disorderly collapse of the banking and derivatives nexus, but it did so by explicitly revealing the market's profound fragility and its total dependence on the central bank backstop. The immediate fire was contained. What followed was the grim global assessment of the damage and the sober dawn of a new, fearful market reality, one where the Fed put had been exercised at an enormous cost to credibility, and where trust in the self-correcting nature of markets lay in ruins. The crash timeline was over. The era of reckoning had begun. By November's end, the panic had subsided, replaced by the grim calculus of a new reality. The S&P 500's peak-to-trough decline settled at a punishing 34%, erasing over a third of its value. The technology-heavy NASDAQ 100 was eviscerated, down 42%. The VIX had touched an apocalyptic 86.7. In credit markets, high-yield corporate bond spreads had ballooned by 600 basis points, signaling a deep freeze in corporate funding. Globally, an estimated $18 trillion in financial wealth had vanished, a destruction of capital not seen since 2008. The psychological damage was more profound and permanent. The buy the dip mantra, the cornerstone of a 14-year bull market, died. Retail investor sentiment surveys plunged to historic lows. A generation of investors weaned on the certainty of the Fed put, and algorithmic stability confronted, for the first time, true uninsured market risk. Trust was the ultimate casualty. Structurally, the market was permanently scarred. Liquidity did not fully return to pre-crash levels. Market makers, burned by catastrophic losses, demanded a higher liquidity premium to intermediate trades, making transactions more expensive for everyone. This fragility sparked a philosophical reversal. Active management and strategic cash holdings saw a powerful resurgence as the core dogma of passive investing, its inability to provide liquidity or downside protection in a crisis, was brutally questioned. The regulatory and political fallout was immediate and seismic. Legislators called for draconian new rules targeting the shadow banking system, leveraged ETFs, complex structured notes, and the private credit funds whose fire sales had accelerated the crash. Hearings were scheduled to scrutinize the role of authorized participants and the systemic risks embedded in passive vehicles. This hypothetical event was not a random, unforeseeable bolt from the blue. It was the logical, almost inevitable manifestation of financial history's most enduring lessons about leverage, liquidity illusion, and crowd behavior that were ignored in the long complacency of cheap money. The crash of 2024 would be remembered not for its triggers, but for the stark, painful truths it forced the financial world to relearn. This timeline is plausible not because of clairvoyance, but because it is a synthesis of every major financial crisis of the modern era. Its mechanics are drawn from an analytical autopsy of history, revealing 4 timeless, ignored lessons. First, liquidity is a mirage until you need it. The 2008 crisis revealed the runnability of shadow banking. The 2020 dash for cash exposed the fragility of the U.S. Treasury market itself. Modern structure prioritizes high-frequency trading and ETF efficiency over the deep, committed capital required to absorb genuine panic, creating a dangerous illusion of always available liquidity that vanishes instantly. Second, leverage is the common poison. Whether it was portfolio insurance in 1987, subprime securitization in 2008, or the explosion of Treasury basis trades in 2020, the agent changes, but the toxin is constant: excessive debt. Every crisis is, at its core, a violent, synchronized deleveraging event where borrowed money is forcibly recalled. Third, correlations break at the worst time. The foundational promise of diversification, that when one asset falls, another will rise, is a fair weather friend. In true systemic stress, as seen in 2008 and 2020, the only thing that rises is demand for cash. Stocks, bonds, and commodities fall together, rendering sophisticated risk parity and 60/40 models pro-cyclical engines of collapse. Fourth, the catalyst is less important than the tinder. The 1987 crash was blamed on program trading, 2008 on subprime mortgages, 2020 on a virus, but these were merely matches. The true fuel was always the pre-existing condition, a system saturated with leverage, complacency, and structural fragility. As former Fed Chair Alan Greenspan reflected on 1987, we learned that the markets are far more fragile than we had previously perceived. The specific spark is random. The combustibility of the system is not. The purpose of this exercise isn't fear. It's preparedness. It is a stress test of both portfolios and psychology. So if we cannot predict the spark, what must an investor do, not to forecast the storm, but to build a resilient shelter against it? The hypothetical 2024 crash is not science fiction. It is a stress test built on the very real, observable vulnerabilities present in today's markets. The parallels are stark and documented. First, historic concentration. The top 10 stocks in the S&P 500 command a weight not seen since the peak of the dot-com bubble, echoing the Nifty 50 era. The market's fate is tied to a narrowing group of mega-cap technology stocks, creating a single point of failure. Second, embedded leverage. While bank balance sheets are stronger post-2008, leverage has metastasized elsewhere. Corporate debt is at record highs relative to GDP. Margin debt remains elevated. Most critically, leverage is now engineered into products through explosive growth in 0 days to expiration, 0 DTE options, and the massive opaque private credit market, making it harder to see and measure. Third, the liquidity illusion. The passive investment revolution has created a dangerous perception of depth. While ETFs trade with high volume, the underlying markets, especially for corporate bonds, municipal debt, and small-cap stocks, have seen dealer capacity evaporate. The ETF wrapper masks a profound underlying illiquidity. Fourth, the dominance of systematic strategies. Trillions of dollars are now governed by quantitative models for risk parity, volatility targeting, and trend following. These strategies do not assess value. They react to volatility and momentum signals in unison, creating a powerful mechanistic herd. This leads to the critical difference between 2024 and 2008. The epicenter of risk has shifted. Today's fragility lies not in the traditional regulated banking system, but in the vast, less regulated non-bank financial system, the hedge funds, private equity, pension funds, and the intricate automated web of ETFs and derivatives that connect them. This shadow banking system is more opaque, interconnected, and prone to instantaneous, non-discretionary runs. A crisis here could propagate faster and be less predictable than in 2008. We cannot know the trigger, a geopolitical flashpoint, an inflation resurgence, a political crisis, or simply the exhaustion of a long economic cycle. The key is not predicting the what, but understanding the how these documented vulnerabilities will interact and amplify initial stress. This documented reality, contrasted against a prevailing belief in a more resilient new system, follows the exact historical pattern where unforeseen fragility is born from the solutions to the last crisis. This analysis leads to the only logical conclusion for an intelligent investor. The goal of this timeline isn't to scare you out of the market, it's to scare you into intelligent preparation. In finance, hope is not a strategy, resilience is. We must shift from a fragile, optimization-focused mindset to an anti-fragile one, seeking to benefit from volatility and uncertainty, not just survive it. This requires a concrete checklist derived from our analytical autopsy. First, respect liquidity. Hold a meaningful, non-negotiable allocation to cash or short-term treasuries. This is not merely dry powder for buying dips. It is a stabilizer that gains in purchasing power during a liquidity crunch as other assets collapse, providing psychological and strategic ballast. Second, interrogate your diversification. True diversification isn't about different stock sectors. It's about holding assets with genuine negative correlation to equities during a crisis. This includes certain commodities, managed futures, CTAs, or explicit tail risk hedges, assets that are often uncomfortable to hold in a bull market but become priceless in a crash. Third, deleverage systematically. As bull markets age and valuations stretch, a prudent strategy is to systematically reduce leverage, whether margin debt, mortgage exposure, or the embedded leverage in the products you own. Voluntary de-risking is always less painful than forced liquidation. Fourth, understand your vehicles. Know what's inside your ETFs and funds. Do they hold liquid, transparent assets or complex, opaque securities that could become impossible to price? Passive investing is not a set and forget exercise. The sobering truth is this. In markets, what is comfortable is rarely profitable, and what is profitable is rarely comfortable. The comfortable action today is to be fully invested and passive. The prudent action is to build a portfolio that can weather a storm you cannot foresee. Don't try to time the crash. Time your preparation. Stress test your holdings. Ask the hard what-if questions now. The timeline of the next crash is unknown. The formula for surviving it is not. Liquidity, optionality, and humility.